Hello and welcome. In this course, we will explore borrowing costs based on International Accounting Standard 23. IAS 23 borrowing costs was adopted by the International Accounting Standards Board, IASB, in April 2001. The standard was originally issued by the International Accounting Standards Committee, IASC, in December 1993. It replaced IAS 23 capitalization of borrowing costs, which was issued in March 1984. In March 2007, the IASB issued a revised IAS 23 borrowing costs, which eliminated the option of immediately recognizing borrowing costs as an expense. Subsequent standards introduced minor consequential amendments to IAS 23. One such amendment was made by agriculture, bearer plants, amendments to IAS 16 and IAS 41, which was issued in June 2014. Further changes came with the issuance of IFRS 9 financial instruments in July 2014 and IFRS 16 leases in January 2016. Lastly, the annual improvements to IFRS standards. 2015-2017 cycle issued in December 2017 made additional refinements to IAS 23. International Accounting Standard 23 borrowing costs, IAS 23, is structured into 30 paragraphs along with an appendix. All paragraphs hold equal authority, maintaining the original IASC format from when the standard was adopted by the IASB. To fully understand IAS 23, it should be read in conjunction with its core principle, the basis for conclusions, the preface to IFRS standards, and the conceptual framework for financial reporting. Additionally, IAS 8 accounting policies, changes in accounting estimates and errors, serves as a reference for selecting and applying accounting policies when explicit guidance is not provided. Borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset are included as part of the cost of that asset. All other borrowing costs are recognized as an expense in the period in which they are incurred. This standard applies to accounting for borrowing costs. However, it does not cover the cost of equity, including preferred capital, that isn't classified as a liability. There are also cases where an entity doesn't have to apply this standard. These include qualifying assets that are measured at fair value, like biological assets covered by IAS 41 agriculture, and inventories that are mass-produced or manufactured repeatedly in large quantities. This helps ensure the standard is applied only where relevant, making financial reporting more practical and consistent. This standard uses the following terms with specific meanings. Borrowing costs are interest and other expenses that an entity incurs when borrowing funds. A qualifying asset is an asset that takes a substantial amount of time to be ready for its intended use or sale. Borrowing costs can include interest expense calculated using the effective interest method, as described in IFRS 9. Interest on lease liabilities recognized under IFRS 16 leases, and exchange differences arising from foreign currency borrowings, but only if those differences are considered an adjustment to interest costs. These elements help define the borrowing costs that fall under the scope of this standard. Depending on the circumstances, qualifying assets may include inventories, manufacturing plants, power generation facilities, intangible assets, investment properties, and bearer plants. However, financial assets and inventories that are produced over a short period of time are not considered qualifying assets. Additionally, assets that are ready for their intended use or sale when acquired do not qualify as qualifying assets. An entity must capitalize borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset as part of the asset's cost. Any other borrowing costs should be recognized as an expense in the period they are incurred. Borrowing costs directly related to the acquisition, construction, or production of a qualifying asset are included in the asset's cost. These costs are capitalized as part of the asset when it is likely they will lead to future economic benefits for the entity and can be reliably measured. If the entity applies IAS 29 financial reporting in hyperinflationary economies, any part of the borrowing costs that compensates for inflation is recognized as an expense for the same period. Borrowing costs eligible for capitalization are those directly attributable to the acquisition, construction, or production of a qualifying asset. These are the costs that could have been avoided if the expenditure on the asset had not occurred. When an entity borrows funds specifically for the purpose of acquiring a particular qualifying asset, the borrowing costs directly related to that asset can be easily identified. It can be challenging to identify a direct relationship between specific borrowings and a qualifying asset, and to determine which borrowings could have been avoided. This difficulty arises, for example, when an entity's financing activities are coordinated centrally. Additional complications occur when a group uses various debt instruments at different interest rates and lends those funds to other entities in the group. Further challenges are created by loans denominated in or linked to foreign currencies, operations in highly inflationary economies, and fluctuations in exchange rates. As a result, determining the borrowing costs directly attributable to the acquisition of a qualifying asset requires careful judgment. When an entity borrows funds specifically to acquire a qualifying asset, it determines the borrowing costs eligible for capitalization by calculating the actual borrowing costs incurred on that borrowing during the period. This amount is then reduced by any investment income earned from the temporary investment of those borrowings. In cases where an entity borrows funds for a qualifying asset but doesn't immediately use all of the funds for the asset, the borrowed funds are often temporarily invested until they are needed. When calculating the borrowing costs eligible for capitalization during a period, any investment income earned from these temporarily invested funds is deducted from the total borrowing costs incurred. When an entity borrows funds generally and uses them for acquiring a qualifying asset, it calculates the amount of borrowing costs eligible for capitalization by applying a capitalization rate to the expenditures on that asset. This capitalization rate is based on the weighted average of borrowing costs from all the entity's outstanding borrowings during the period. However, borrowing costs from funds specifically borrowed for acquiring the asset are excluded from this calculation until most of the activities required to prepare the asset for its intended use or sale are finished. The total borrowing costs capitalized during the period cannot exceed the borrowing costs the entity incurred during that period. In certain situations, it is appropriate to include all borrowings of the parent company and its subsidiaries when calculating the weighted average of borrowing costs. However, in other cases, it may be more suitable for each subsidiary to use a weighted average of the borrowing costs that apply to its own borrowings. This depends on the specific circumstance of the group and how the borrowings are managed. If the carrying amount or expected ultimate cost of a qualifying asset exceeds its recoverable amount or net realizable value, the carrying amount must be written down or written off in line with the requirements of other applicable standards. In some cases, if conditions change, the amount of the write-down or write-off may be reversed following the guidance provided by those other standards. Capitalization of borrowing costs as part of the cost of a qualifying asset begins on the commencement date. This date is when the entity first meets all of the following conditions. It incurs expenditures for the asset, it incurs borrowing costs, and it begins activities necessary to prepare the asset for its intended use or sale. Expenditures on a qualifying asset include only those that result in cash payments, transfers of other assets, or the assumption of interest-bearing liabilities. These expenditures are reduced by any progress payments received and grants received in connection with the asset. The average carrying amount of the asset during a period, including borrowing costs previously capitalized, is typically a reasonable approximation of the expenditures to which the capitalization rate is applied during that period. The activities necessary to prepare the asset for its intended use or sale go beyond just the physical construction of the asset. They also include technical and administrative work that takes place before the actual construction begins, such as activities related to obtaining permits. However, holding an asset without engaging in any production or development that changes its condition does not qualify for capitalization. For instance, borrowing costs incurred during the development of land are capitalized when related development activities are being carried out. However, borrowing costs for land held for future building purposes, but without any development activity, do not qualify for capitalization. Capitalization of borrowing costs should be suspended during extended periods when an entity halts active development of a qualifying asset. During such periods, borrowing costs are incurred for holding partially completed assets and cannot be capitalized. However, if substantial technical and administrative work continues, borrowing costs should not be suspended. Likewise, a temporary delay that is part of the necessary process for preparing an asset for its intended use or sale does not require suspension of capitalization. For instance, if high water levels delay the construction of a bridge, capitalization of borrowing costs would continue during the delay, as such water levels are common in that region during construction. Capitalization of borrowing costs should stop when substantially all activities required to prepare a qualifying asset for its intended use or sale are finished. Typically, an asset is considered ready for use when its physical construction is complete, even if routine administrative tasks continue. Minor modifications, like decorating a property to meet the purchaser's or user's specifications, signal that almost all activities are complete and capitalization should cease. When an entity completes a qualifying asset in parts and each part can be used while the construction of other parts continues, the capitalization of borrowing costs should stop when substantially all activities are complete for each part, making it ready for use or sale. For example, a business park with multiple buildings that can be used individually while the construction of other buildings continues fits this scenario. However, in cases like an industrial plant, with processes that must be completed in sequence across different parts of the site, such as a steel mill, capitalization continues until the entire plant is finished and usable. An entity is required to disclose the amount of borrowing costs capitalized during the period, as well as the capitalization rate used to determine the amount of borrowing costs that are eligible for capitalization. When the application of this standard results in a change in accounting policy, an entity is required to apply the standard to borrowing costs related to qualifying assets for which the commencement date for capitalization is on or after the effective date. However, an entity has the option to designate any date before the effective date and apply the standard to borrowing costs related to all qualifying assets for which the commencement date for capitalization is on or after that designated date. The annual improvements to IFRS standards. 2015-2017 cycle, issued in December 2017, amended paragraph 14. An entity must apply those amendments to borrowing costs incurred on or after the beginning of the annual reporting period in which the entity first applies those amendments. An entity shall apply the standard for annual periods beginning on or after the 1st of January 2009, though earlier application is permitted. If an entity applies the standard from a date before the 1st of January 2009, it must disclose that fact. Paragraph 6 was amended by improvements to IFRSs issued in May 2008. An entity must apply this amendment for annual periods beginning on or after the 1st of January 2009, with earlier application permitted. If an entity applies the amendment for an earlier period, it must disclose that fact. IFRS 9, as issued in July 2014, amended paragraph 6. An entity shall apply this amendment when it applies IFRS 9. IFRS 16, issued in January 2016, amended paragraph 6. An entity must apply that amendment when it applies IFRS 16. The annual improvements to IFRS standards. 2015-2017 cycle, issued in December 2017, amended paragraph 14 and added paragraph 28A. These amendments must be applied for annual reporting periods beginning on or after the 1st of January 2019. Earlier application is permitted, and if an entity applies those amendments earlier, it must disclose that fact. This standard supersedes IAS 23 borrowing costs, which was revised in 1993. The amendments in this appendix must be applied for annual periods beginning on or after the 1st of January 2009. If an entity applies this standard for an earlier period, the amendments in this appendix should be applied for that earlier period. New text is underlined, and deleted text is struck through in the amended paragraphs. The amendments made in this appendix when the IFRS was issued in 2007 have been incorporated into the relevant IFRSs published in this volume. International Accounting Standard 23 IAS 23, as revised in 2007, was approved for issue by 11 out of the 14 members of the International Accounting Standards Board, IASB. 3 members, namely Messrs. Cope, Danjou, and Garnett, dissented. Their dissenting opinions are outlined following the basis for conclusions. The following board members were part of the approval process: Sir David Tweedy, Thomas E. Jones, Mary E. Barth, Hans-Georg Bruns, Anthony T. Cope, Philippe Danjou, Jan Engstrom, Robert P. Garnett, Gilbert Gellard, James J. Lysenring, Warren J. McGregor, Patricia L. O'Malley, John T. Smith, and Tatsumi Yamada. Thank you for completing our course and for the attention and dedication you've shown throughout. We are happy to have contributed to your professional development and encourage you to help us improve by providing your feedback. If you have any questions or suggestions, feel free to reach out via email at info@qlever.al or through the contact forms on our website. Also, we invite you to follow us on social media and our YouTube channel to stay updated on upcoming training sessions. Thank you once again, and we look forward to seeing you in our future courses.